Stock markets remain volatile, moving up and down all the time. Falling prices are common, and when it falls beyond 10%, we call it a correction. Let's see how often this has happened. This is a study that was done on S&P 500 index. You will see that the market has corrected twice or thrice every year. In the 10 years of analysis, the markets have corrected 16 times, which is roughly once every 7 months. Statistically speaking, every time market has hit a new high, it is corrected before again making a new high. The corrections have been in the range of 10 to 20%, and once in a decade, we can also see sharp corrections like 35% as we did in 2020. Every single time, market has recovered and went on to make new highs. This is the data on our Indian markets for the past 40 years. Markets again have corrected 10 to 20% every year. There was not a single year when the markets did not correct. However, while the markets corrected during the year, it recovered by the end of the year, registering a 20% positive return on an average. So it was not as bad as it initially looked. During volatile times, investors think that the market could fall further and stop their SIPs. Fear takes over. There is a cost to such emotional reaction. It reduces the return. The investment returns from uninterrupted SIP is 18% versus 15% if you had stopped the SIP. In all the three scenarios, it is not how the stock market behaved that resulted in different returns on investment. It is how we reacted and how we managed our investments that made the difference. Our behavior as an investor is more important than our investments. When the stock market is rising, everyone feels in control over their investments. But the key is to have a similar discipline in market corrections, which happens every year. Now assume you exited just in time before a crash. It is extremely difficult for you to enter back again. And I will show you why with the most recent example of the Corona episode. The whole country was placed in lockdown around March 25th, 2020. An investor would have considered himself lucky if he had sold and exited from the stock market around this time. Now see the most interesting part, the market had already hit the bottom on 23rd March, 2 days before the lockdown, and even started recovering. The market kept going up even while the cases were spiking and all the bad news were hitting us. Remember, the world was not prepared for anything remotely close. There was absolute panic and fear in every home. All this while, the market kept making new highs. From the point when the lockdown was announced on March 23rd, 2020, and to the peak of the first wave, which is September 2020, the market had already given a return of 31%. The peak of the second wave was in May 2021. By then, market had returned 70%. This was the time when investors sitting on the sidelines would have gathered courage to enter back. Such an investor would have completely missed out the 70% rally. He would then anchor himself to the price at which he sold and will not be able to re-enter as the prices have already gone up. The summary is that the market recovers much faster than the real economy and before the situation improves. Market makes a U-turn in between the worst times and in bad news. When clarity emerges, the prices are very high. The question we need to ask, are we ready for a 10 to 20% temporary decline? Are we having surplus funds so we do not convert this notional loss into a permanent loss? That brings us to the end of this video. If you liked it, please do subscribe to my channel, like and share it with your friends. Thank you.